Okay, now we can combine aggregate demand and aggregate supply, and we create the aggregate demand aggregate supply model. So this is a very powerful, simple little model that we can use to explain and understand almost any changes in any economy. So let's start out with our aggregate demand curve. Right? So it's that downward sloping that tells us what individuals, businesses, government, and the rest of the world is willing to purchase at various sets of prices in the economy. And then we've got our short-run aggregate supply curve, which tells us what the firms in that economy are willing to produce at various given levels of prices. So we have an initial equilibrium at point A, and this sets our price level. So it tells us the price level in the economy is PA, and that the GDP here is GDPA. Now, let's assume that the economy is at full employment. So if that's the case, then our long-run aggregate supply curve is going to be a vertical line going down through here. And so we would call this aggregate supply long run. And then, of course, we know that this is full employment, so we can change our GDPA here. We'll call it GDPF to indicate that it's full employment. So now we can begin to tell a story. So let's assume that it's 2008. So point A here actually corresponds to 2008. So our economy is doing well. Everyone's got a job, so we'll call this 2008 down here. Now, when the recession hit, it was caused by a financial crisis which led to a decrease in wealth. Right? So if we feel less wealthy, people are going to not spend as much. And so what happened is we had a leftward shift of the aggregate demand curve. Right? So we got aggregate demand goes from 80 to 81. So we had a decrease in aggregate demand, so this leftward shift. And so now, generally what would happen is we'd end up at a point like C down here, but we have to remember that in the immediate short run, we've got prices are sticky, so we've got this aggregate supply, immediate short run. And so what ends up happening is that instead of going to a point like C, we actually go all the way back here to a point like B because prices don't drop. And so what we found then by 2009, when the recession hit, we were at a point B, so this corresponds to 2009, and then we are at GDP 2009. So the economy really shrunk in 2009 as a result of the recession. Now, eventually, right, prices, so we went from point A to point B. Now, eventually, prices became unstuck and prices began to drop. So late 2009, we actually had negative inflation. So at 2010, we ended up at a point like C. So what we ended up having was prices dropped. So the price level dropped to PC. And then the economy actually began to grow. So this was GDP 2010. So as the prices became unstuck, prices dropped. We actually began to buy a few more things. And so the recession started to end and our economy began to grow. Now, what happened next was the government then decided, hey, we need to give this economy a bit of a boost. And so they increased G. Now, G is a determinant of aggregate demand. So as they increased G, the aggregate demand curve shifted to the right to aggregate demand 2. So now this was an increase in aggregate demand. And again, this was caused by an increase in G. In government spending. And so then we moved to a point like D. And so again, now we started to see prices increase. So we saw prices increase to price level D. And then we had the economy began to grow even more. And we'll have to stick this somewhere here. So this was GDP. Now this was by 2011 because the stimulus packages had started to kick in. So point C here is 2011. And then we know that if there's an increase in spending, there's a multiplier effect. And so then the multiplier effect kicks in, and that pushed us back to original aggregate demand curve. So this time it's the multiplier. And so we ended up back at point A. So then again, this is 2012. And so our economy ended up coming back full circle. So again, we can use this very, very simple aggregate demand, aggregate supply model to tell a very powerful story of what happened in 2008 through 2012. Now let's look at a different example. So suppose we're at equilibrium A. So we're operating at GDP full employment. So we're at the intersection of the short-run aggregate supply curve and the short-run aggregate, or the aggregate demand curve, and the long-run aggregate supply curve at a price level A. Now let's suppose that something happens and aggregate demand increases. So we've got a rightward shift to the aggregate demand curve. So let's say we pay off a whole bunch of debt, so our household debt goes down, and we know if that happens that aggregate supply will increase to aggregate supply 81. So in the short run, we move from point A to point B. Okay? So we move here. Now this is the short run. Okay, so what we need to remember is that wages are fixed. So let's suppose now that we're Bombardier and we're selling snowmobiles. Now all of a sudden we can sell our snowmobiles for more money because the price level has gone up to P2. So, but our wages and our input costs haven't changed. So that means that we are making more money per snowmobile. So our profitability has gone up. So that'll give us an incentive maybe to hire a few more workers, extend shift periods, maybe put on a second shift. So in the short run, when we're making that profit, we're going to move from point A to point B. Now in the long run, remember we determined that wages are now flexible. So now when those wage contracts are up and then employees negotiate for a new wage, they're going to say, hey, the price level's gone up. We're not making as much real income. We need a raise. Now, what we know is if there's a raise to the employees, so that's an increase in the cost of labor, which is input factor price. So that's going to shift the supply curve to the left, right? So then we're going to go to aggregate supply 1. And then what we'll see then is that the new equilibrium will now be point C. And so prices will go up yet again to price levels P3. So we have a movement from B to C occurs in the long run. So now this is a long run change when wages become flexible. So this is one of the problems, especially when aggregate demand increases when we're already at full employment, because what it'll mean is, yes, the economy will grow a little bit, so we'll grow to GDP, we'll call this B, corresponding to point B, but because we're above full employment, especially, is there's going to be a real tendency for wages to increase, and then wages increasing will cause the aggregate supply curve to shift left, and so we'll end up right back where we were at GDP full employment, only the prices have gone up. And then this also helps us understand why the aggregate supply in the long run is this vertical curve at full employment.